This was supposed to be the year of M&A, and yet the beginning of the year has been anything but that.
We haven't really seen it yet, but the last couple of months and some other really important early indicators are saying we still may see a back end of 25 with a booming banner year from M&A. And we're going to look at that today on the Altimetry Authority show.
Let's talk earnings and favorite pastimes.
So let me just say, earnings
worth 5 Wall Street. It's 2.5x
because their compensation goes up.
Wall Street's wrong again. I don't know about you, but I remember back in November and December of last year and January of this year, everybody was beating the drum on the story for this year, amongst other things, was going to be an M&A explosion. That with the new administration tearing down the walls of regulation, telling regulators to just be more open and working more closely with industry, that we were going to see an M&A boom in places like banks that need consolidation, companies like industrials that need to strongly aggregate to be able to supply us for the supply chain supercycle, and in smaller tech equipment suppliers. And right, Trump basically and the administration did everything that they said they were going to do. Right, basically one of the first things that Trump did when he came to office was sign Executive Order 14192, which was unleash prosperity through deregulation. The idea that we had to cut 10 regulations for every regulation that was enacted. You also saw, right, the Trump administration telling the DOJ and the FTC, look, we need to get back to, instead of just saying no to mergers, let's talk about remedies. Is there some smaller thing that a company can sell? Is there some sort of carve out that we can do to make sure that we can actually let M&A happen? So when consolidation has to happen, it can happen. And right, replaced Lena Khan, who was aggressively against pretty much any M&A, not just big tech M&A, but any M&A, with Andrew Ferguson, who has taken a more measured approach. And yet, with all that news, the reality is M&A did not pick up like we would expect. So everybody, just looking at this chart right here is through December 2024. And the bars, that is aggregate M&A, merger and acquisition volume. How much money was spent in mergers and acquisition announced to be acquired each month over the last 3 years, 2 years beforehand. That black line is how many acquisitions was announced, right? Between 3,000 and 4,000 any given month. Well,
so
you can see count.
The line chart, the line is the count, the number of acquisitions announced in that month, and the bar is the total value of those acquisitions. And they do tend to go in sync, but sometimes you get a large flurry of smaller deals, and sometimes you get a flurry of larger deals in that. And that's why it's worth looking at both.
Yeah, exactly. And what you can see is we were seeing in the back half of last year a pretty nice buildup in terms of acquisition activity. And then here's what happens, right? The Trump administration comes in office, and we see deal volume tank. Right, I mean, investment bankers certainly care more, Joel, right, when we say about the bars and they care about the lines, because they make their VIG, their commission, based on how much money is spent on M&A. And what all of them were staring at is a bunch less M&A volume. And why was that, everybody? The reason why is because of the fact that everybody had a lot of uncertainty. Yes, there was the idea of deregulation happening, but between greater tariff uncertainty with the administration out of the gate talking about being more aggressive on tariffs, between uncertainty about taxes and tax policy because the big beautiful bill wasn't passed yet, and just in general the flurry of things going on, everybody kind of put everything on hold. Now, in March, we did see a big jump in activity. Right, one, we saw the number go up a little bit in terms of the number of transactions, but overall volume went up. And the reason why was right because everybody was trying to rush to get their deals and everything in place before the tariffs got in place in early April. But then what happens? In April, again, deal volume collapses. Why? Because, again, now we've got the tariffs actually hitting, and everybody goes, I don't know what's going on. I don't know if we actually have any visibility, so everybody hit pause. But then, Joel, something really interesting happened in our data, in our proprietary data, which told us that we might see some more openness from corporations to just invest more in general, which might have trickled through in M&A. You want to walk everybody through what this chart means?
So this is an early indicator signal. This is something we do run that's proprietary. Over the last decade plus, we have run 50,000 earnings calls, the actual calls by management teams, every quarter. We run their calls through, and we're measuring the signals that we get where we hear confidence. Now, historically, people used to do this based on word choice. Did they use words and wording and sentence structure or whatever? Today, you can do a lot more sophisticated work with just audio analysis. So at one level, you're looking at audio stress from management's actual voice, but you're also looking at confidence. You're also looking at, do they even have like butterflies in the stomach, which actually you can measure in the tonal, right, in their vocal cords, in their tone. And so we've been using this technology for a long time. It's basically an electroaudiogram. It's a cognitive and emotion analysis indicator. And we look at the total amount of confidence versus the total amount of concern, if you will. Confident and excitement markers versus what we call questionable or highly questionable markers that you can get in the voice of management. What we've seen historically is that when we see management showing large levels of confidence, it means more growth, more investment, more spending by the companies, and more mergers and acquisitions, more M&A. And what we're seeing is one of the biggest positive spikes that we've measured in a long time. The change from what we saw for the first, the back end of 2024 and early 2025, and a marked change in both the 3-month moving average as well as just what we measured in the last month in terms of management showing massive amounts of confidence over hundreds and hundreds of calls that we run, these earnings calls. And it gives us a broad swath of the S&P 500 and really the S&P 1500. And what we're seeing is this confidence level that suggests they're gearing up for CapEx spending, for growth, and, frankly, for mergers and acquisitions.
Right. And so the thing that happened here is, right, as Joel, you mentioned, like this took off this in the last month or two where we just saw a ton more bullishness from management teams basically really effectively saying, hey, look, we're actually starting to feel like we understand what the game is here. And no surprise, from the levels that we were in January, February, and April, we've seen acquisitions pick up significantly in May and June. And the data hasn't been released yet for July and August, but it's likely picking up there too. And the reason why is quite simple, because you already had the table set, right? The table was set by this deregulation push and this focus on making it easier for businesses to do business that the administration has been focused on. And now that management teams have the biggest issue that's been an overhang for them, which is uncertainty, you're going to start to see this spending increase. And, just because for context, everybody, investors often forget this. What management teams hate most, just like actually investors, isn't bad news or good news. It's uncertainty. And so once you can remove that uncertainty, all of a sudden the gates can come open, and we're likely to see a banner second half of this year in M&A because of how this setup is happening and because we have a whole bunch of pent-up demand that is now actually being able to clear. So watch for the rest of this year. Get excited because it means really good things for the stock market as well. Yeah, go ahead, Joel.
And in general, historically, the most acquisitions occur in the second half of the parent, the acquiring company's fiscal year. And of that, most of those acquisitions occur in the fourth quarter. So you definitely see a ramp up. So if we're seeing this level of acquisition activity and we're mid-year for most fiscal year, calendar year companies, that bodes very, very well for the likelihood that we're going to see a third and fourth quarter do very, very well in terms of a lot of M&A activity.
Exactly. And we're going to be talking about this a lot more in the coming months because we expect this to be a big narrative for the rest of the year. So keep on coming back to the Altimetry Authority. And if you like this conversation, hit the like and subscribe button and come back for next time. Thanks, everybody.